What's up, everybody? This is Austin Lieberman, and I'm back. And as usual, I'm here to help you and myself become a better long-term investor so that we could do more things we love, like spending time with our family, having fun, going to the beach, sitting inside recording YouTube videos, whatever it is. Anyways, let's jump to it. Gotta say, I'm not a financial advisor. This is information only. Make your own decisions, do your own research. Today, I'm talking about two dividend stocks that I own and that I'm looking to buy more of, that I'm not scared to own, even if we go into a big scary recession like everybody's talking about. So we're going to jump into the video, and I'm going to show you a little bit about why. Let's get started. First up is 3M. Ticker is MMM. And this is just a fast graph that shows a lot of data about the stock. So the important thing here is this black line, which represents the current stock price, about $140 a share. This orange line is the fair value based off the earnings growth of the stock. This blue line is the normalized PE ratio, price to earnings ratio, over the last 14 years, which is 19. So we see today the stock is trading below the fair value and below its average PE ratio. So even if it were just to get back up to fair value by 2024, you're looking at an 8.8% annualized return. If it were to get back up to its average price earnings ratio, you're looking at an 18.5% annualized return. But not only that, you're also getting a 3.29% dividend yield over that time. And what I love about 3M, as we think about the potential for some type of recession, this political turmoil we're seeing, whatever's going on, is that even if we zoom out back to 2007, they continued paying their dividend. You could see 2% dividend yield, 3% dividend yield, 2.45%. Their dividend actually did not go down through 2008. We see $1.89, $1.98, $2.02. And if you look at the price, even since before leading into 2008, the recession, to now, you're still looking at a 7% annualized return. And that's a 155% return since then. So, almost tripling your money over that time. And just in case you're wondering, what does 3M do? They make products, abrasives, adhesives, advanced materials. They're in electrical products, films and sheeting. Everybody knows them for sticky notes. The point is, all of this stuff is, pretty important for the most part, and the demand for that is not just going to go away. I like to look at some dividend stocks on Simply Safe Dividend just because they do a good job of displaying kind of the safety. And so this is showing the dividend yield of 4.23%. So it's a little bit different from what that was showing, but that's just the difference in the way they collect the data and current versus forward dividend yield potentially. Either way, it's a pretty decent dividend payer. The safety, which is their ability to continue paying, is rated at 75. And then the big thing down here is 63 years of a dividend streak. And then in 2007 to 2009, they increased their dividend. And so just a good example that even in one of the worst recessions in our memory, this company was still able to not only survive, but increase the dividends that they paid. Let's jump into Morningstar and what Morningstar thinks about 3M. Again, they've got the fair value at 192. The last closing price was 140, which gives them a 4-star rating. They say it has a wide economic moat, and their capital allocation for management is standard. So all around, 3M is a pretty good looking opportunity at this point for investors that are interested in something like that. Next company we're going to talk about is Amgen. So again, we're going to start with Y charts, right? We're going to look at this black line and see if it's over or undervalued. And right now, based on future projections, the data is telling us that it's undervalued and that we get an annualized return out to 2024 excuse me, of about 9% for a 28% total return. If it gets back up to its normalized PE ratio, and if it gets up to what they have fair value at, actually, the return is a little bit better, 12.6% annually, or a 40% total return. And again, we can see here that through the recession in 2007, 2008, not only did they didn't pay a dividend back then, I apologize, but they started in 2011, and ever since then, it's grown every single year, and it's now yielding about 3.1%. Could be a little bit higher, and we'll see on the next page. What does Amgen do? They're one of the world's leading biotechnology companies. They say they're a value-based company deeply rooted in science and innovation to transform new ideas and discoveries into medicines for patients with serious illnesses. And so let's hop to Amgen on Simply Safe Dividends. They've got them at a 3.39% dividend yield with a 74 dividend safety rating, which is safe. They grew the dividend 10% in December of 2021. They have a dividend streak of 10 years without a reduction. And again, the latest growth was 10%. Let's see what Morningstar has to say about Amgen. Again, it's a 4-star rated stock. They have the fair value at $260. Last closing price was $228. The economic moat is wide. The capital allocation is exemplary. And there's just an update here that the war in Ukraine is unlikely to significantly affect big biopharma valuations, which is one of the reasons I like this as a dividend stock and just a stock in general in this situation. And then, as always, I like to lead with transparency. This is commonstock.com. This is my profile there. Full disclaimer, I am an employee at Commonstock because I loved the product so much that I applied and wanted to work at the company. But anyways, it's free, and it's an awesome community for transparent investing because people can link their portfolios securely if they want to. And so what this is showing my current portfolio, the performance. Year to date, yep, I'm down. Who isn't? But not worried about that. I'm a long-term investor, and just showing you, the point of showing you this right now is to show you that I own 3M. It's about 2.6% of my total portfolio, and I own Amgen, which is also about 2.6% of the portfolio. So if you enjoyed this, video, make sure to leave a like in the comments. You can follow me. I have an email newsletter. I go a little bit deep into analyzing stocks. If you like deep dive reports, austin.substack.com. Please subscribe to the channel, like the video, share it with your relatives. If you don't like them, share it with them anyways. And come back and we're going to be talking about some growth stocks that I like right now as well. Have a good one.